As of the market close on Thursday, July 2, 2026 at 4 p.m. Eastern Standard Time, Datavault AI Inc., trading under the ticker symbol DVLT on the Nasdaq, settled at exactly $0.38, representing a sharp single-day decline of 4.90%. The broader markets were closed on Friday, July 3rd in observance of the Independence Day holiday, leaving this microcap equity resting near its lower support bounds after experiencing an absolute whirlwind of intraday volatility, where it peaked at a high of 45 cents before cascading down to an intraday low of 38 cents. While the superficial narrative surrounding a stock trading at these levels points directly toward distress and retail capitulation, the underlying mechanics of this specific trading session revealed something far more compelling that most casual observers completely missed. On a day where typical small-cap equities saw dry liquidity, this company witnessed an explosion in trading volume, with over 34 million shares changing hands, a massive deviation from its standard baseline that signals a severe institutional rebalancing and a high-stakes battle between short sellers and aggressive accumulation. The prevailing logic among mainstream retail traders looking at popular investing sites is that any stock sitting comfortably below the $1 threshold is an automatic trap destined for endless dilution and eventual delisting. When individuals log on to their Robinhood stock trading interface or scroll through their basic individual brokerage feeds, the immediate instinct is to look at high-flying mega-cap tech like Nvidia stock or Apple stock, assuming that micro-cap tech names are purely speculative noise. However, the reality of Datavault AI Inc. challenges this basic assumption because the company is actively anchoring its balance sheet to physical asset networks, specifically through its recently proposed $700 million framework with Patriot Strategic Metals. This massive structural step stands in stark opposition to the standard penny stock narrative, creating a profound tension between what the general public expects from a 38-cent asset and the physical, industrial scale of what the business is trying to secure. Analyzing the technical footprint of this recent downward swing reveals that institutional liquidation and programmatic shorting have pinned the price down even as structural development suggested different long-term outlook. Over the past 52 weeks, the stock has traded in an incredibly wide and punishing range, reaching as high as $4.10 before collapsing to its absolute floor of 25 cents. For anyone engaging in online investing through platforms like Interactive Brokers or managing their retirement setups via Fidelity IRAs, this type of price action represents extreme structural damage that scares away conservative capital. The immense volume spike during the latest drop indicates that large blocks of shares are being rotated out by early-stage private placement investors who are locked into specific risk parameters, while sophisticated entities are utilizing Interactive Brokers trading systems to accumulate blocks at deep discounts. This massive friction between forced selling and strategic buying is creating a highly compressed coiled spring effect in the chart, where the current price does not reflect the projected annualized revenue target of $200 million that management has consistently reiterated for the back half of this fiscal year. This severe divergence between sentiment and operational execution became glaringly obvious during the presentation of the first quarter financial results for 26. The company actually managed to deliver a significant surprise, beating analyst consensus forecasts by posting an earnings per share loss of 9 cents against the anticipated loss of 14 cents. In normal market conditions, a clean bottom line beat paired with a stable revenue generation of $3.42 million would trigger a sustained upward rally, especially for an entity with a modest market capitalization hovering around $331 million. Instead, the expectation of immediate profitability collided with the reality of heavy capital expenditure, causing the stock to plunge over 14% down to the 50-cent mark immediately following the announcement. Investors managing their personal accounts through SoFi Active Investing or utilizing self-investing strategies on a Fidelity brokerage account panicked over the rising cost of revenue and the escalating research and development expenses, which climbed to $5.73 million for the quarter. The institutional landscape reveals that despite the retail panic visible on modern trading apps, a substantial amount of shares remains concentrated in hands that are built for longer holding periods. Mutual funds, exchange-traded funds, and other institutional asset managers hold over 37% of the outstanding shares, leaving the remaining 62% to the general public and retail participants. This dynamic means that when market volatility strikes, the price swings are heavily amplified by retail emotion on platforms like the Robinhood app or through simple online investment setups. Meanwhile, larger firms utilizing Fidelity wealth management services or sophisticated institutional channels are evaluating the firm based on its underlying asset backing rather than daily microcap fluctuations. When you look at the broader technology sector, the average price-to-book ratio sits around 2.4, while Datavault AI trades at a conservative 1.5 times book value, indicating that from a pure asset perspective, the equity is selling at a noticeable discount relative to its peers. To understand why this financial dislocation exists, one must look directly at the unique operational architecture of Datavault AI Inc., which operates out of its headquarters in Beaverton, Oregon. Founded originally in 2010 and changing its corporate identity to reflect its current focus in early 2025, the company specializes in real-world asset tokenization, digital credentialing, and enterprise data monetization. Instead of relying on traditional software licensing models, the business model is built around creating digital twins and secure ledger assets for industrial applications, bridging the gap between advanced technology and tangible industrial materials. The proposed partnership with Patriot Strategic Metals is a perfect reflection of this framework, as it integrates mining interests, refining links, and supply chain infrastructure with the company's patented blockchain-based settlement systems and enterprise software platforms. This massive structural step is designed to satisfy the accelerating global demand for secure access to critical minerals needed for advanced manufacturing, robotics, and defense systems. Comment below how many shares of Datavault AI Inc. you currently hold in your portfolio, or share your thoughts on whether you believe the real-world asset tokenization sector can successfully stabilize microcap tech equities in this current economic climate. Looking ahead, the future trajectory for the stock hinges on a delicate balance of specific regulatory catalysts, execution timelines, and macroeconomic shifts. The primary upside driver remains the successful deployment of the first phase of the Strategic Materials Acquisition Platform, which could funnel up to $62 million directly into the company's technology licensing and compliance automation pipelines over the coming months. Furthermore, management maintains a robust liquidity position with $250 million in total availability and $140 million in working capital, which provides a critical operational runway to fund these large-scale deployments without the immediate threat of survival-driven equity dilution. On the flip side, the major structural risk lies in the company's heavy operational reliance on the pending legislative passage of the Clarity Act to provide a definitive regulatory framework for tokenized commodities. If this legislation faces extended political delays or unexpected revisions, the company's ability to onboard large institutional clients onto its digital escrow and settlement platforms will be severely throttled, forcing the stock to sustain its current depressed valuation. When you evaluate the broader investing ecosystem, from individuals optimizing their capital through a Schwab Intelligent Portfolios account to active traders utilizing the SoFi trading platform, the lesson of this specific equity is entirely about the gap between narrative and substance. The market is currently pricing this asset as if it were an unbacked speculative software concept running out of runway, entirely ignoring the reality of its substantial cash reserves, institutional backing, and its pivot towards asset-backed industrial infrastructure. While high-profile assets like Tesla stock dominate the daily financial news and capture the vast majority of retail volume across popular investing sites, microcaps like this one represent the areas where deep structural mispricings actually occur. For the discerning investor analyzing the technology landscape through a Fidelity mobile app or executing calculated trades on an interactive broker's platform, the current price compression highlights a distinct scenario where the fear of small-cap volatility has completely decoupled from the company's verified financial steps. Ultimately, the long-term resolution of this trend will depend entirely on whether management can convert its massive asset-backed frameworks into realized smooth revenue during the second half of the year, transforming a 38-cent market anomaly into an authoritative infrastructure player.